Okay, hello everyone. So this is a recording of a finish of chapter 15, and specifically we want to talk about the difference in the standard model of nominal exchange rates between a long run and short run analysis within the scope of the model that we have. So the only difference really in this text between long run and short run is that prices adjust in the long run. So the assumption until now in our analysis was that we do not have enough time for prices to adjust, and we know that prices in fact tend to be quite sticky very often, or rigid, and consequently without price adjustment and with consequent price rigidity, we always assumed that nominal variables and real variables are the same thing because there was no inflation or no expectation of price changing and so on and so forth. So that'll be relaxed. So now we will have a situation in which in the long run prices are flexible, and we will therefore need to talk about how money supply, the influence of money supply may be nominal only as opposed to being real, because with fixed price until now, nominal and real money supply were the same thing, and as a result, changing of money supply by the central bank had a real effect because it was also changing a real money supply. So by real effect we mean output maybe increased or decreased, and that's not what we were talking about here, but that would be the standard sort of first, second year macroeconomic analysis about how monetary policy can influence unemployment due to the Phillips curve trade-off and due to simply influencing the ability of the real value of people's incomes, if you like, and their behavior both on the side of the consumers and on the side of the firms. So in the long run, we won't have that. So in the analysis after, let's say, typically this is over 1 year and longer, the effects, prices had a chance to adjust. Firms often choose their prices to last for a certain period of time. Normally, firms establish relationships with other suppliers as well as consumers. They don't necessarily wish to reprice every time there is new information. Also to not annoy their partners, but also because it's costly to reprice in the short run. But in the long run, whatever that means, and we'll be basically looking longer than a year, could be 2 years, depends on the macroeconomic environment, prices will be assumed to move. But then we'll need to say a little more. So the model is by necessity going to be a little bit more complex, because we no longer can just say the real output, the real incomes are simply moving when not money supply moves. So we'll have to have something else to say about what determines the real output and real income, and we'll therefore also have to talk about the real interest rates as different from nominal interest rates. So moving on, in the long run, the money supply is predicted to not influence the amount of output. It'll simply be moving price levels. And that's the second bullet point. And so price is going to be adjusting in the denominator on the left hand side of this red equation here, 1 for 1 with the changes in money supply, if we consider this to be a long run analysis. So consequently, the equilibrium on the money market will have no bearing for real output or real interest rates, because in the long run prices will be adjusting proportionately to the money supply. Consequently, on the left hand side, the ratio will stay unchanged whenever money supply is moved by the monetary policy action, and there will be no need on the right hand side therefore to have a change in the output or in interest rates. So we can rewrite this equation, and we can take first differences of it. So if I rewrite it, the money market equilibrium as money supply equals price level times this demand for real money balances that we described on the previous lecture. Rewrite it further by putting price on the left and dividing both sides of this equation by L, we get the second equation, and taking a difference, or well, basically differentiating this. So we can think about it as thinking about this equation in terms of percentage changes. So on the left-hand side, if we take a derivative or if we think about percentage changes, we can simply express the equation as percentage change, or change in the price level. And on the right hand side we have three variables. There's one in the denominator, and that's the money supply, so we'll have a percentage change in the money supply, and two are in the denominator. Now the variables in the denominator, if we express this as a percentage changes, they will be subtracted rather than added. So if you differentiate, if you're familiar with basic calculus, if you totally differentiate this relationship, you would have to subtract the derivative of the denominator, which is what we're doing here. So, but this is in a discrete sense, so rather than continuous sense. But it doesn't matter. It's a percentage change. Percentage change in the real demand for money balances. Okay, so inflation, therefore, that's the left-hand side, is predicted to equal percentage change in the money supply, or growth rate of the money supply, less whatever the demand for real money balances is doing at the same time, less however much the demand for real money balances is changing simultaneously. Okay. So if we ignore the second part, the L, and we simply say the money balances don't really, the demand for money balances doesn't really change very much, then we can say approximately these two should be proportional to each other. So a 1% change in the money supply should result in 1% increase in inflation rate. This has been studied quite a lot. So if we look at this figure here, and many other figures, and you can just go to World Economic Outlook, which is a semi-annual or every 6 months, 6-monthly web, and not just web, it's a document, but it's primarily a web-based document of the International Monetary Fund. You will find a database associated with it every year, and very thorough analysis of world events. So this is from one of their World Economic Outlooks, probably for the year 2008, or just before the financial crisis, the global financial crisis. And what do you see on the horizontal side, on the horizontal axis, is the percentage increase in the money supply, on the vertical percentage increase in the price level. And as you can tell, this is for a group of countries that are rich. There is a very strong association or correlation between them along the 45-degree line, which is exactly what you would expect from this relationship on the previous slide if percentage change in demand for real money balances was indeed zero. So it matches pretty well. That's not necessarily telling us much yet, but at least we know that the inflation rate should approximately equal percentage increase in money supply in the long run, less, of course, an adjustment for demand for real money balances that could be actually coming from growth rate of output. So if we assume that growth rate of output, or we can think growth rate of income, translates into people demanding more money, and real output does grow over time, we should be really subtracting that from this number. So that's so we can have inflation rate, for example, equal to 0 if money supply grows at a rate of 2% and output grows at a rate which generates 2% growth of the real money demand. Okay, so they would exactly grow at parallel money and demand for money and money supply. Therefore, prices wouldn't need to change. So there are different ways we can think about this in terms of structural changes, or in terms of how does this actually come about. The main one is simply an excess demand for goods and services. So, either excess demand or insufficient demand, or excess supply or insufficient supply, depending on the situation. Here, let's just talk about an excess demand of goods and services, or for goods and services. So if you print more money, and give it or distribute it somehow to people, that implies that people have more money to spend, and they will simply going to go about and bid up the demand for bid up the prices, I should say, of goods and services. So with more money to spend, people presumably save some, but we're not really modeling the saving behavior here, but they will be spending some. So more funds will be available to buy stuff, and with that, producers will presumably want to supply more to match the demand for goods and services. So the producers will be willing to hire more workers, and that should result in this derived demand, which is demand for factors of production, primarily for workers. And so in order to attract more workers, that's the second from the bottom, second last bullet point, wages will have to rise. So wages will need to rise to attract more workers, or to compensate workers from working overtime. And eventually, if wages, which are a major component of costs of firms, are rising, then prices of output will eventually rise also to compensate for these higher costs. And this is an environment where there's not much, bargaining power on this is a perfect competition, so to speak. Of course, you could think of a situation where there isn't perfect competition and there's demand coming at your door as a seller, and you'd be willing to just charge a high price, and nobody else would take these consumers away from you in a world of imperfect competition. So that's an alternative channel. Oh, that's this bullet point here. The second main avenue, and of course this was an excess demand, so it was an increase in money supply, but you could think about a decrease in money supply working exactly the opposite way. The other way is to think about expectations. So even though prices do not change immediately, people do know that with more money being printed, there will be more inflation in the future, and these expectations have immediate effects on wage contracts and price contracts that are set. And that's because wage and price contracts are set in a staggered fashion, so they are set in advance. So if you write a contract with your employer and somebody hires you, usually it'll be not renegotiated every couple of weeks or a couple of months. It'll be something where you'll have a certain salary or a certain rate which will be paid to you for a period of time, and it could be a year or two. And so these contracts are negotiated. When you're agreeing to this contract, both the worker and the employer, both sides have to have some kind of expectations about what's going to be happening in the economy in the coming period of time, at least for the duration of the contract. How much business is the company going to have? What's the macroeconomic environment going to be doing? Is it going to be a boom period, or are things much more stagnant? And in particular, both of you will have in mind, the employer will be thinking, how much are my costs going to be growing? How much are my revenues going to be growing? Can I afford? What are the wages that I'll be able to afford? And likewise, the worker, the employee, is going to be thinking about the cost of living increases, and these expectations will translate into negotiation about the current wage, about the wage that will prevail for the duration of the contract. So that's one way, or an alternative way through which prices transpire to higher output and higher inputs. So it doesn't need to be through demand for goods and services, which is in excess of the current production. It could simply be expectations. Okay, so if you expect these prices to be higher, consequently you would charge a higher price today. Now, if we look at the data for this is for Japan, US-Japan. So exchange rate and price level changes. You see that there's I guess the main thing you can see is that the red line is a lot more volatile than the blue line. So the exchange rate changes are a lot more volatile, and this is more than one order of magnitude. This is almost like 2 orders of magnitude more volatile than price level changes. So in principle, this is going to be a persisting problem in macroeconomics if you continue to study international macroeconomics. That is, exchange rates tend to be a lot more volatile than prices, and so standard explanations using, for example, PPP or some other explanation, in fact, any explanation which uses real variables such as relative prices or outputs or expectations of growth to explain exchange rate changes is going to fail. And the reason is that we don't really see variables, real economic variables, moving this dramatically over periods of time as the red line is moving, as the exchange rate is moving. So it's kind of difficult. There is this so-called disconnect puzzle in between nominal exchange rate movements or values and the real economy. And we'll a little bit allude to that later on, but basically just something to keep in mind when we try to evaluate. And we'll actually use it to motivate this one simple model, which will predict why exchange rate should be overshooting or excessively responding to changes in, for example, expectations or some variables. But even that overshooting story by Dornbusch cannot actually generate this kind of volatility that we observe in the real world. So, moving on. Right, so and this is actually what we're going to do right away. So let's just assume that prices are sticky initially and eventually adjust. Unlike prices, exchange rate can move immediately, and that's very realistic. But also, people. So let's just say that prices are not adjusting for reasons of so-called menu costs, which you may have heard of. So menu cost is just literally the cost of printing a menu, but in general, just cost of changing a price. So it's a cost which will motivate a business to not change prices all the time, but wait until it makes sense, in the sense of profitable opportunity to change, to revise the prices. So as a result of the menu cost, basically prices are rigid for periods of time. But let's also assume that expectations about inflation can change immediately. So people can expect things will be happening, even if the prices themselves are actually not adjusting immediately. Yeah, and that's also quite realistic. So those two expectations, keep them in mind. And basically, let's just go through an example here. On the left-hand side, we have the short-run diagram, which is what we've seen in lectures last week. And on the right-hand side, we have the same thing, but in the long run. So we'll just be discussing how the adjustment process differs in the long run and the short run. So the scenario we're looking at is an increase in the home money supply. Okay, so an increase in the home money supply results in a decrease in the interest rate at home. So that's the rate of return on the domestic asset goes down. So that's a movement of the real interest. Nominal interest rate and real interest rates are the same in the short run. Down from R1 to R2. If nothing else happened, and that's a consequence of the increase in the real money supply from M1 over P1 to M2 over P2. Right? So this is the diagram that we worked with last week. But additionally, I'll go back a few slides. We have this equation which tells us that prices are linked to changes in money supply, and so people are aware of this. We assume in our model, in our explanation, and they realize that although prices are currently fixed, eventually, when prices in the long run, let's say, this increase in the money supply is going to result in an increase in the price level. So, bringing back to this diagram, if price levels are rising, we would expect that the exchange rate on the domestic currency is going to be depreciated in the future. Or, in other words, we would expect that the euro return is going to go up for any level, current level of the nominal exchange rate. Okay, so, and that's crucial for this overshooting argument. So, when we start expecting this increase in the domestic exchange rate, which is a depreciation, of course, or an appreciation of the euro, to be higher in the future, the expected euro return line, this green line, which is downward sloping, shifts to the right or upwards. So for any level of exchange rate, the euro will have a higher return. Remember, this is a return which is denominated in the home currency. Okay, so now we can kind of think about what actually happens in the short run. The initial shock, or the source of this change, is a movement of the money supply from 1.1 to 2, and on the flip side of the diagram we see an exchange rate responding from initial level at E1 to level E2. So we are moving from point 1 to point 2 on the intercept or in the equilibrium. So this is going to be, I'll explain to you shortly, an overshoot in a sense, because the equilibrium long run level of the exchange rate is going to be at point 3. I'll explain why, which is kind of on the right hand side here. But that's where the idea or the notion of an overshooting comes from. So the fact that you expect the depreciation to happen, which is shifting this curve to the right, and that's a rational expectation simply because we know that prices will rise and therefore depreciation has to follow, is resulting in an expectation of a higher return in these in euro deposits when denominated in our home dollars. All right. So what happens? So that's a short run analysis. In the long run, prices adjust. Prices adjust, and they adjust so that they match the increase in the money supply. We're assuming that there is nothing happening with the real money demand. So going back to this equation, basically we are ignoring this part. We are setting it to 0, but we are allowing in the long run prices to adjust. So if prices go up 1 for 1, that implies that the money supply in real terms has to go back to its initial level. Right? So we had initially money supply in the denominator on the left rise, with P being fixed. Now P in the long run rises by the same amount, so the ratio shrinks as a result to the initial level. So think about this being 1 over 1 initially, moving to 2 over 1, and eventually prices catching up to 2, and so the ratio becomes 2 over 2, which is exactly the same as 1 over 1, so basically the ratio declines. So the real money supply declines as a result of the pricing increase in the long run. With that, we would expect a movement along this red real money demand curve and a gradual increase in the home return. Okay, so the home return has to go back to where it was initially, because we're basically just reversing this initial increase of the real money supply. So the real money supply is returning back to where it started from, and therefore the real interest rate has to return back to the same level as the level at which it was initially. In the meantime, this expected return line doesn't change at all. There's nothing changing about expectations. The expectations have already been adjusted immediately on the left-hand side of the diagram. So we're just shifting the equilibrium from the short run to long run position as the real exchange rate, nominal exchange rate decreases, which of course here means appreciation of the dollar, decreases from level E2 to level E3. So if you trace this, you are starting in point 1, you're going then to point 2, and eventually go down to this point here, which is point 4, basically. So initially the exchange rate starts at some level, it quickly rises, and then it declines, but it declines not completely, but it declines a little bit to the long run equilibrium, which is above the starting position. Okay, so movement up is a depreciation. So the depreciation is a very large one initially, and then there is a slight appreciation while you're moving to the long run equilibrium. Okay, so that's basically the overshooting argument. So a permanent increase in the money supply results in proportional, so 1 for 1, long run depreciation of its currency. But the dynamics of it is a little bit, if you like, tricky, because initially the depreciation is much larger because prices are sticky, and as a result, to eventually arrive at the final depreciation, you have to appreciate actually. So it makes more sense when you plot it in time space. So that's these figures here. So exchange rate starts at this level up until point T0, which is the point at which the money supply increase occurs. It jumps up, and then it gradually adjusts back to where it's supposed to be in the long run. So, and this process is called overshooting, right? And you can trace the other variables. So this is quite a nice way of actually analyzing, or maybe easy way to understand or to plot over variable values over time for the variables of interest. So here we are permanently increasing, so the source of the shock is this left-hand side, upper left-hand side, money supply change from level M1 to M2. we have explained in the graph why this results in a change in the interest rate. Okay, so this second part is the dollar interest rate, which drops initially. So the short-run analysis is just this T0 initially drops and then starts increasing. And the reason why it starts increasing is that prices, which is level segment C, are gradually adjusting. Initially they are sticky, they are not moving, and they gradually start increasing to their long-run level. And with all those is associated a response of the nominal exchange rate. So the nominal exchange rate overshoots its long-run value. Okay, so I mentioned that. And this all goes back to Dornbusch in 1970 something, so a long time ago. So it's not really that new, but the idea is, can we explain why exchange rates are this volatile? And if you take this model seriously, this Dornbusch overshooting model, you can explain part of it, but not completely. But there's a literature basically on this, and the researchers try to put some effort into understanding why exchange rates are as volatile as they are. And in a nutshell, without going technical, we could you can think of exchange rates as basically buying stocks of the whole economy. We know stock prices are very volatile, they respond to all kinds of news, and they just refer to a value of a given company. But just if you think about buying a share of the whole country, then there's a lot of things that can change your opinion about what the value of that country's stock is. So positive shocks could result in large movements, or any shocks, large shocks can result in very large movements in the nominal exchange rate. If you just buy this sort of picture, I haven't explained anything, but if you can just buy it for now and think, well, it's kind of an asset price explanation of price of a country's currency, in the sense of instead of thinking about it as price of currency, think about it as a stock of a country, or an asset or share of a country. Alright, so that's basically it for chapter 15. I think we've covered quite a bit. Then in a nutshell, we were trying to link the diagram that we used in the previous chapter. I'll jump to the start. So this diagram here. And we're trying to come to the source of this short-run explanation for nominal exchange rates by explaining where the interest rates differentials come from. And in our simplistic world, we just talked about two countries, and we talked about monetary policy in those two countries, and the monetary policy determining the interest rates. And we see this very much kind of happening. You just think about the recent Brexit and so on. So that was the whole purpose of this chapter. At the end, which is where I started this recording from, at the end we move towards the long run, and that's the whole next chapter 16. And the long run explanation is basically a little bit more complicated, but it's also interesting in a sense, because it's assuming that prices are no longer fixed, and so what is exactly long run is unknown, but it's approximately 1 year or 1.5 years and longer. Prices have a chance to adjust by that time. And that gives us this response of, in our model, in our very simple graphical model of nominal exchange rate, which we can call overshooting. And I explain why that overshooting occurs. Okay, and that's basically it for this chapter. There's a whole bunch of other things, and you can read the summary obviously, but see how that goes. Next I will be recording chapter 16, which solely deals with the long run view of exchange rates, and there we will have to talk about real exchange rates, not just price differentials, but also real economy. So it will be a little bit more complex, but at the same time will be a little bit more realistic. Alright, so see how I can finish this off.